Hi, thanks so much for joining in. You're watching BQ Prime. My name is Alex Matthew. Now, I've had a number of conversations on the sidelines of the Morningstar Investment Conference, and all of this is geared towards getting you some perspective as to how to approach your investment decisions. And my next conversation is no different, but this conversation, I'm promising you, you need to listen to it through and through. I'm joined by Vikas Khemani, the founder of Carnelian Capital. Thank you so much, Vikas, for taking the time and speaking to BQ Prime.
Thank you for having me.
So I'm starting with this broad question because I think that lays the context for all of the conversations that you would have right now, Vikas, which is that there are so many moving parts. What are you focusing on?
I mean, see, I don't know any time when there are no moving parts. So when you are in investing world, there are always something or other moving, right? Or there is always some uncertainty around because it's all about future investing. But if you look back and with this peaceful context, if you see, there's a global situation, there's a local situation, right? There's the India setup, and so there's no doubt that globally macro setup, especially for the developed markets, are not so great. The potential risk, interest rates are at 5%, it's fairly high, and there could be potential risks around that. Geopolitical is neither rosy, a lot of complexities out there. So, and that is what is creating right now where the markets are. Probably it's one of the, today the fear factor is very high even in our market. But the good news is that if you look at, and investing in my opinion is all about long term. You look at 3, 5 year, 10 year kind of horizon. And these are the times when they offer you this kind of exciting opportunities. And I do believe that India is in a transformative phase. What we are seeing ahead of us over next 1 decade is phenomenal. I think we will see a massive wealth creation opportunity ahead of us. Country will leapfrog. Our economy will go to $5 or $6 trillion, and that would lead to massive wealth creation. So when you zoom out, right, then you see this massive wealth creation. But when you zoom in and start focusing on a short-term horizon, then you start getting worried. So my only suggestion to everyone is that zoom out. Don't focus on short term, don't focus on, when you zoom out, you will see there are enormous possibilities, enormous opportunities. And if I have a capital which is 5, 10, 15 years, I don't need to worry about, if I buy something, it goes down 5%, 10%, shouldn't bother me, should be fine, because ultimately the end game or eventual journey looks pretty bright. So I would say zoom out and stay focused on the medium to long term.
Don't miss the forest for the trees, right?
Forest for the trees. Yeah.
But having said that, I think the desire and the objective of a lot of investors is to identify opportunities that will give them that alpha and that will give them that kicker, so to speak. So therefore, from your perspective as somebody that builds portfolios, are you concerned at this juncture that there is froth in the system, that some of the investments that you've made, say, over 3 years back, you would necessarily have to reduce some of that?
So again, if I were to compare with 3 years back, there was a deep undervaluation. And deep undervaluation in the context, if you made that world will come back. If you did not make the assumption that world will not come back, then that time also was not cheap. Yeah. So ultimately it was always what hypothesis you had about the world to come back. World has come back, so that undervaluation has gone away. Today we are in a fair value range. But the good news is that the growth still looks very, very robust from now to next 5, 10 years, right? So when you look at this kind of situation, I can tell you in a long term companies leapfrog. Like I will say, we have seen how Infosys went from 100 crore market cap to, let's say today, 7, 8 lakh crore market cap, whatever that number is. Now, if you were, let's say, 93, 94 at 100 crore, and then in 2000 you were at like 1 lakh crore, but still it is, from there also it's done well, right? So when there's a big opportunity, companies create massive wealth. Sun Pharma went from 1000 crore market cap to 3 lakh crore market cap. Like that, many companies, L&T from 10,000 crore market cap to what we see. So I see that, the big money is made when you just remain invested in good quality company which are benefiting from a structural trend, and that's what we are doing. Of course, if you feel that market has priced in the next 5 years growth and probably things are not looking as great, I mean, we don't mind booking some profits. We do that time get out and get into the opportunity where we think risk reward is there. So it is more not at a macro level, but more at the
individual
business level, stock level, that how do we see business doing well? Are there better opportunity compared to what we own? Those are the kind of things you got to look at. We never do saying that, oh, markets might correct next 5% from here and let's take some money off and we'll get back. That is not something we advise and we do.
No, fair enough. But having said that, over the last couple of weeks, we've seen, shall we say, and you pointed out absolutely the most important point, which is that there's never a time when there's no volatility, right? It's all relative. But over the last couple of weeks, where we've seen that move down from 20,000 plus levels down to 19,000, did you use any opportunities to book profit?
Like I said, again, it is not about
individual. I'm talking about individual.
We've done that. We booked some profit. We were sitting on some cash. Sure. We have kind of now deployed at around these levels. But they were not based on some market timing call. They were based on the stock specific call that we wanted to get out, and we were lucky that market came down, and hence we exited, and we could take some advantage of that. Sometime you may be right, sometime you may be wrong on that. But to be very frank, we don't really look to optimize on the short-term correction.
In terms of the amount of cash that you're comfortable holding and have held in the past, and if you look at now versus times in the past to kind of draw a correlation to that and say, where do we stand right now? From your perspective, how do you describe that?
So I am quite still optimist on the market. I don't see major risks in the market. Of course, if there are some major development happens in the developed market, we might see some temporary correction happening or volatility coming through. That nobody can predict. But structurally speaking, I don't see much risk in the market. So I would say, we are right now not much cash, 3-4%, 5% cash, depending on which fund we are talking about. But we don't have a lot of cash, and if market comes down, we'll probably deploy that as well.
Fair point. You said that we are in a fair value zone, and there have been certain commentators that have maybe gone to the extent of said that while we're not in a bubble zone, we're a little stretched on valuations. That doesn't seem to be your thinking. You think that the earnings justifies that and there is significant upside. That's fair?
I would say that at the market level, I don't think it is stretched. Okay. There are pockets of euphoria, overvaluation are there. They will always be there, and you got to avoid them. So we try to avoid more at a level where we think that there is too much euphoria. Stay away from that, and we do that. But I don't frankly see market level any at a console level any major valuation stretch.
Because traditionally, when we've talked about India as a structural story, we've talked about the banking system that presents significant opportunities. We've talked about the IT sector that has presented significant opportunities. Both those sectors are going through a little bit of a change. If you're talking about HDFC and the story and the fact that it has such a large weightage, right? And again, I know you've pointed out that you don't look at market level, you're looking at individual stocks. But from the perspective of the investor that looks at these, how should you understand the way that these sectors are moving, and how are you viewing the development?
No, so I think we think that banking and financial services is very, very promising sector. It can't happen. Their economy grows to $5 trillion and banking does not grow. It's not possible, right? It's a lifeline or a bloodline of the economy. So banking will do well. And in fact, if you ask me, banking is in one of the best shape ever. Your balance sheets are well provided. Your asset quality is in good shape. Most banks are now well governed. Technology is reasonably at good shape. So you have a fairly good setup for the banking, especially banking, and even other financial services, whether it is asset management to wealth management to insurance. Everywhere there is under penetration, massive growth lined up, especially as the per capita income goes up, savings go up. So they will do very well. I mean, I have no doubt we have overweight in entire BFSI space. Same thing, I think IT also, if you look at structurally speaking, there's more of IT in everybody's life, whether it is individual or corporate. And also the IT changes are happening very fast, right? So whenever this kind of transitions happen, there is somebody who has to provide you services, who has to provide you solutions. And that's what our IT companies do. They provide solutions at a global scale to the global companies and to the businesses which are very, very complex. So I think they will be doing well. They will be and it's not my data, but NASSCOM has guided after a very long period of time a very accelerated growth that our IT sector will go from $190 or $200 billion of exports to $500 billion over the next 6-7 years by 2030. That itself says that what kind of growth is lined up. Now within that, some companies will do well, some will not do well, but the sectoral is well placed. In fact, some of the AI talk which is happening about that only helps IT sector company, because some of the work which they would do through the bodies can be done through the bots and AI. So to that extent, cost of delivery for them can go down and could be margin accretive, or can help them to get faster growth.
So concerns about discretionary spending, concerns about execution of orders, that's all temporary, and you should zoom out basically.
Again, if you look at every other day, we see IT companies getting order, right? Infosys got all $1.5 billion order. So just think about it. If somebody is giving order in US right now, he knows what can happen. Recession can happen, right? Despite he is giving. Now, how it is non-discretionary? I mean, how it is discretionary? It is non-discretionary.
Because it's required.
It is required. It could be either for survival or it could be for the cost cutting. Both. So it means that IT is serving something which is essential for survival. And so discretionary spend will come, in fact, when the interest rate starts coming down, when the economy those spends will come later. But today, even IT sector is benefiting from the survival spend.
Okay. According to you then, and you're seeming very constructive on the markets even as they stand right now heading into next year, it's going to be critical to watch certain developments in the political landscape as well. Is that a key risk, or do you think are you sanguine?
Technically speaking, yes. We are, we have seen a transformation at a country level in last 10 years or so, or 9 years or so. So if something were to happen, to the current political dispensation, there will be disappointment. But whatever little understanding of politics I have, currently doesn't look like that risk is around the corner. But in politics, you never know anything. So that's a risk, but currently I am not overly worried on that.
Globally, then, so everyone's talking about the fact that it's not risk asset versus risk asset globally. It is the flow from risk asset to fixed income, because US Treasury yields are at what, 5%, and that's risk-free effectively, right? But globally, what are the key risks that you would watch out for heading into next year then?
No, again, in US, it never happens that such a sharp rise in the interest rates have happened, and no major repercussion economic crisis have happened, right? I mean, we have not seen, except I think SVB which got plugged. We haven't seen any systemic level, sort of crisis coming out, problems coming out. So, and in a complex interrelated world, one doesn't know, to be very frank, how it can happen. So, what are the potential hidden liabilities when the interest rates go up so sharply? There has to be some losses somewhere. Where are they hidden? Where are they? Those things worry you, but you never know, because this time around the debt is more at the sovereign level rather than the corporate and household, and sovereign level debts can continue to remain or losses can continue to remain hidden or covered for a very long period of time. So risk can come from US, some repercussions of that. Geopolitical, of course, is, if it escalates, it could make things very complex. Other than that, I think don't see and maybe one more risk, probably inflation could remain slightly higher than markets think, because I think the whole last 30 years of China supplying deflation to the world is going away. And as that happens, cost of production, cost of goods is going away up across the world. So inflation is here to sustain for long. So hypothesis that interest rates might come down back to zero should not be there. Probably we have to get used to in and around these kind of rates, and maybe slightly softer, a couple of years down the line.
Yeah, I guess everyone's now talking about higher for longer. Final question: would you be a buyer on every dip?
Absolutely, I have no doubt on that. I remain fully convinced about India's story. I believe that India is a very deep and wide story. I have never seen in my career of 25 years so many sectors doing well simultaneously. You have banking and financial services doing well. Manufacturing has found a new, sort of growth for next 10 years. IT is doing well. Your consumer is doing well. Your infrastructure, we know that how money is being spent on roads, railways, ports, airports, everything else, right? Your startup ecosystem is doing well. So, your whole economy, all aspects of facets of economy is doing well. When that happens, it has a huge multiplier effect or amplifying effect, and that is going to play out. And the most interesting part is, today India, despite being such a promising market, is well underrepresented in the global portfolios. So I reckon, or I see a situation where over the next couple of years, massive capital flows can come towards India once the dust settles down. and that could be a time when you can see a massive re-rating of India happening.
Fantastic. On that note, Vikas, thank you so much for speaking to BQ Prime. Always a pleasure.
Pleasure talking to you. Thank you.